It's time for this week's Lucia Capital Group weekly video. I'm Rick Plum. If you find yourself with a little bit of extra money to set aside as savings, one question you might have asked yourself is whether you should invest that money for future growth or use it to pay off or just down your mortgage. It's an issue that many people grapple with, but they're never quite sure of the answer. There are two components to consider here, the rational and the emotional. When considering the rational side, it's almost purely a matter of just going over the numbers and doing some calculations. One way to look at it is like this. If you pay off a mortgage debt that's costing you, say, 4% over the 30-year time span, or however many years you have left on the mortgage, you are in essence earning a guaranteed 4% rate of return on that money. You're keeping the 4% that you would have spent in interest. But could you have earned a higher after-tax rate of return if instead you took that extra money and invested it in somewhere else? The after-tax part of this question is important because if you invest and earn, say, 5% on that money, hypothetically, but you're in a high tax bracket, it's likely you'll end up with less money on a post-tax basis than you would have by putting it towards the mortgage, because taxes will eat into your return. But if, after taxes, you could earn even more on an outside investment, the numbers would indicate that it might be better to not pay down the mortgage. Now, then of course, you've got the risk factor. Let's say you discover that you could potentially earn more by investing somewhere other than your mortgage, but in order to earn that, you'd have to take significant risks. Well, then things aren't as clear. In order to make an actual apples-to-apples comparison, you'd need to have the same guarantees on both investments. Now, that's really difficult to do. It could be a bit easier if your mortgage has 15 years or more left on it because time can help mitigate some risks. But if you only have 3 or 4 years left on your mortgage, it's doubtful that you'll get those guarantees. Then there's the liquidity factor. If you pay down your mortgage, but then someday discover that you need money back, well, you'd be forced to borrow it from the bank, which may be impossible to do if the emergency you're facing involved the loss of a job, and thus your ability to repay. Also, paying down the mortgage balance does not change the monthly payment on a fixed rate loan, so your cash flow is still the same. Paying down the balance only reduces the time you have to pay. The other component is the emotional one, and this can play as big a role as the rational side. Maybe you ran all the numbers and found that it's better for you to invest the money elsewhere instead of the mortgage. Yet in spite of that, you just believe that you'd sleep much better at night without that mortgage balance hanging over your head. In that case, even if the real numbers say otherwise, you possibly should pay down or even pay off that mortgage. So you can see the conflict here, which is why I said that many people are never quite sure of the answer. It really boils down to both hard numbers and individual sentiment, and you have to decide which one is more important to you. In my opinion, generally speaking, with all things being equal, the fewer monthly bills you have in retirement, the better. But everyone's situation is different, and before you make a move one way or the other, it's a really good idea to talk to an advisor who can give you both the benefits and the downsides of the two options. If you're in this particular situation and you want to know which way may be more suitable for you, just give us a call. We do this all the time, and of course, we're here to help.